What if I told you economic collapses are actually the biggest engine for creating new billionaires? While most people see absolute devastation, a select few see the exact opposite, the foundation for their next fortune. You'll soon see exactly how one famous investor used a rarely discussed strategy to make more money during a single downturn than most people see in 10 lifetimes. The mechanism starts with the media. Look at this headline. When the market dips, front pages scream about financial crises and massive sell-offs. That relentless drumbeat of media panic conditions average investors to do the worst thing possible: dump their assets, from houses to stocks, at rock-bottom prices. While the crowd is selling out of sheer terror, the ultra-wealthy are doing the exact opposite. They are quietly and methodically buying everything up. The financial elite treat these periods of collapse as a high-stakes shopping season, waiting for the moment world-class assets go on clearance. This psychological pressure effectively siphons wealth from the panicked majority, moving it into the portfolios of the patient minority. Think about how we treat everyday discounts. If you saw your favorite pair of shoes go on sale for $70, the wealthy view long periods of economic growth merely as the waiting room. The crisis itself is the actual main event, the moment to execute their plans and acquire assets aggressively. The mechanism that makes this possible is liquidity. Having readily available cash is the secret advantage that the ultra-rich stockpile while the economy looks perfectly healthy. When times are good, the middle class tends to take on maximum debt, buying bigger houses and financing new cars. At that exact same time, smart money is quietly hoarding cash reserves. So when the inevitable panic strikes, businesses and real estate values plummet. Those heavily discounted assets become exclusively available to the only people left who still have cash on hand. We saw this play out with brutal efficiency in 2008. Millions of families lost their life savings, and foreclosure signs popped up in front of suburban houses across the entire country. Outside the New York Stock Exchange, average citizens were holding signs begging for relief. Yet behind closed doors, cash-rich investors were scooping up banks, properties, and distressed debt for fractions of their true value. 2008 showcased a massive split in the market, absolute devastation for the overleveraged, and unprecedented acquisition for those holding liquid cash. The stock market is often presented as a complex machine of pure mathematics, but at its core, it is driven almost entirely by human emotion. Fear, hope, and greed dictate the numbers on the screen. And the next market crash is likely closer than you think. When it hits, the vast majority of the public will repeat the exact same historical mistakes, selling off their futures because of a temporary panic. Look at this timeline of a standard market cycle. To survive the inevitable drops, you have to follow 3 rules. Build a cash reserve now, eliminate emotional trading, and study these recurring boom and bust patterns so you recognize that deep panic trough for what it is, a strategic acquisition zone. As this same cycle continues into the recovery phase, notice how the price line eventually bounces back. The depressed prices are always temporary, but the transfer of asset ownership from the terrified crowd to the calculated individual is permanent. When the next downturn arrives, the loudest voices on television and social media will tell you the sky is falling. That noise is just a smokescreen for the massive, quiet wealth accumulation happening out of sight. Ultimately, these events redistribute the ownership of the economy's most valuable assets. By mastering market psychology, you ensure you're on the receiving end of that massive shift.